So welcome, guys, to another great money talk. Happy Tuesday, everybody. Right? Today we're going to talk about all different kind of life insurance today. Right? The topic today is life insurance part two. And as you know, we talked about many different things yesterday. We talked about the why of owning life insurance, but today we're going to talk about the different kind of life insurance that are available. And as you know, we have many types of life insurance out there. We have term life, whole life, all kind of life, right? And it's important for us to know which life is for us. I'm excited to definitely, break this thing down for you guys and show you guys how to really start winning the money game and how to start doing some big things in the industry and put ourselves in a position to be winning at the same time. So, with no further ado, let's jump right into it. What is a term insurance? All right. What is a term insurance? All right. So, some of the things that people don't understand is that insurance policies are pretty much just based upon the cost of insurance, right? That's why insurance policies are based upon the cost of insurance. So when you think about a term policy, I'm going to say something that most people get confused about, but don't get too confused. But when I say it, I want you to just listen to what I say. And the words I'm about to say is that all insurance are term insurance. How many of you guys knew that? How many of you knew that all the life insurance that you could think of are term insurance? Did you guys know that? Right? Because if you didn't know that, then let me tell you why I'm saying what I say. The reason why I say what I say is because the fact that when you think about term insurance, right? Whole life, universal life, variable universal life. All of these insurance are term insurance. Every last one. There's no such thing as a forever insurance, right? There's no such thing. There's no such thing. It doesn't exist. Every insurance has a term. Some insurance are 5, some insurance are 10, some insurance are 30, some insurance are to 100, some insurance is to 121. These are different terms. But it's how the term of the insurance is set up. Some people like short term, some people like mid term, some people like long term. Because every insurance comes down to the cost of insurance, COI. So it doesn't matter what insurance you own. It doesn't matter what insurance you buy. All that matters, right? All that matters is the fact that you must know which one is best fit for you and your family. So let's talk about term, the first term, right? Because remember, everything is based up on your cost of insurance. So here's the thing. What determines your cost of insurance? Well, the cost goes up every year because your risk of dying is higher as you get older. All right? That's one thing you got to know. The fact that it's based on your health. For example, whether you smoke or not can affect your rate. And if you are a female, your rate is lower due to the having better life expectancy. So, ladies, big shout out to you, right? How about the fact that if you're looking at a temporary situation where you want to just have temporary coverage, that's what the first form of term insurance we're going to talk about today, right? Because there's three kinds of term, There's three kinds of different type of term insurance. So let's talk about why people use this. It's a temporary insurance. So there's something called annual renewable term, known as ART, right? Annual renewable term. See, this is where the coverage is for a 1-year term. right? It's renewable every year with a higher price. It costs much less when you're young, but it will be very expensive when you get older, right? This is called annual renewable term. Now, there's annual renewable term where the rates goes up every year, right? Because the term, the price goes up. Remember, the price goes up every year due to your what? You're getting older. The risk of you dying is getting closer. But then you have something that's also called a 5-year level, right? You have a 5-year level term. You have 10-year level term. So what is a level term? Level term means that whatever the term of the insurance is, either 5 years, 10 years, 20 years, 30 years, it means that the rate won't go up until that term is over. So let's say that it was $10 a month for a 5-year term. After the 5 years is over, it probably won't be the same $10 a month anymore. Instead, the rate may jump all the way to, say, $20 a month, depending on the age that you got it at, right? So these are the things that we must understand about term insurance. So yes, you may have a 5-year, 20-year term, or a 15-year term. But after that year, remember, 15 years now pass, and you got 15 years older, so the price go up, right? The price will go up. And because of that, when the price goes up, your premium goes up. And then sometimes, in most cases, most families can't afford it. And that's why they end up lapsing or they no longer get the policy, right? So guys, we really got to understand what term is. Now let's talk about a little bit about decrease in term. Most people use decrease in term for their mortgages. A lot of people use decrease in term for their mortgage, right? For mortgage insurance. It's a very popular one, but why get a decrease in term for your mortgage when you could get a regular level term, which could be even cheaper, and the term doesn't decrease, right? How about the return of premium term? How does that work? A return of premium term, guys, is exactly what it says, ROP. It returns the premium. But it's very expensive. So for example, right? Check this out. Imagine if you put in, say, $1,000 a year for a return of premium term, right? And you did this for 20 years. And then you know you're going to get back your $20,000, right? So you got back your $20,000, and now you have no more insurance, but you got your money back, right? Did you know that that $20 is now subject to being taxed? Because it has no tax. It doesn't have any reasons to be, it's not an insurance money anymore. So now it's subject to pay taxes, right? So there's going to be tax implications on that money. That's something that, yes, you may get your premium back, but you're going to have to pay taxes on it. It's not tax-free money. So yes, there's another form of that as well. How about, is your term in convertible? Are they convertible? Yes, there is some terms that actually is renewable and also convertible. But renewable and convertible is not the issue. It's the fact that you need to know if it's good for you, right? So now, when people think about like something called whole life, guys, don't put everything in one bracket. The bracket where people say, is this, I want a term insurance or I want a whole life. Well, I understand you know the words whole life, but whole life is not representing all insurance. Now, if you say I want a permanent life, right? Permanent life insurance, all you're saying is that I don't want a term insurance. But if you say you want a term insurance, just know that you're telling me that you want something temporary. So if you think about term insurance, think of something that you want temporary insurance. Or if you say, give me something permanent, All you're saying is that I want some term plus some cash value. I want to develop cash value inside of it. So the minute you say, hey, I want to develop some cash value inside of it, I know you want something permanent. But the minute you say I want something temporary, I know you want term insurance. Because temporary insurance is term insurance. Permanent means that you want some term plus some cash value, right? So that's why most people use the word whole life, right? Because they feel like whole life represents cash value life insurance, which it does. But here's the thing about whole life, right? Remember I talked about whole life being like a Nokia, right? And index universal life is like an iPhone. It's a big difference, right? Because here's the thing. Yes, is whole life one of the most original, one of the oldest cash value life insurance? Yes, it is. But here's what you got to understand. Did you know that when you pay for the cost of insurance, you pay a higher premium, and the difference between the cost of insurance and the premium goes into a cash value? Whole life policies give you a guaranteed rate of interest. But that guaranteed rate of interest that you receive from it is sometimes within the 2 to 3%. It's not even high enough for the inflation. Some insurance company may even provide dividends, but dividends are not guaranteed. Did you know that about a whole life? Did you know that the cash value compound with interest build up in the early years will then pay for the higher cost of insurance in the later year, so the policy can actually last its whole life? So whole life is typically not very flexible, guys. The premium is very fixed, the interest is guaranteed, and the death benefit is fixed. Since insurance companies have a guaranteed interest for the whole life, they tend to be very conservative rates. As a result, the cash buildup can be very slow. Say yes. Can you get a whole life? You sure can. But is a whole life something that you want? So let's look at one more thing. Many of you have heard a company, I'm not going to say their name, but how many of you have heard a company that says, buy term, invest the difference? Hit yes real quick. If you know what company I'm talking about, buy term, invest the difference. Hit yes. All right, let me see how many people know this company. Buy term, invest the difference. How many of you have ever got told that before, or are associated with a company that told you that before, right? Not even associated, but you've been approached, right? Or know somebody that been approached that you must buy term, invest the difference. Now, this particular company have this philosophy, right? And it's kind of outdated. It's an outdated philosophy because remember, if all insurance is term insurance, right? And if you're going to invest the difference, the question is, remember what I said about investment? Two things you must know. You must know your tax tolerance, and you must know your risk tolerance. So anybody on here like to take risk with their money when they invest in it? Yes or no? Anybody on this call like to take a risk with their money? Yes or no? Right? You go in your participant section and press yes or no. Right? If you like to take risks with your money, yes or no? So here's the thing. When they tell you to buy term, invest the difference, here's a scenario that they will give you. They will tell you to buy some term insurance. It's cheap, at least if you're younger than when you first started. Let's say that you're 20 years old. You buy some term insurance. They tell you to invest the difference into like a mutual fund or even IRA, right? So now, where does you invest the difference? Or let's say they even say put it in a Roth IRA. I'm even going to give them the benefit of the doubt. Let's say even Roth IRA. They give you options in a mutual fund, IRA, or Roth IRA. Now you have access to each bracket, right? You can get the money taxable, tax now, tax later, or tax advantage, right? Now, here's the thing. How does an IRA work? Isn't that IRA tied to the market? But let's say they put you in a mutual fund. You buy term, you invest the difference. Now, here's what their logic is saying. Their logic is saying that as you get older, you should become self-insured because the invest in the difference would have made up enough money so you become self-insured by having the money. But how can you guarantee me to have money if you're putting my money where it's tied to the market? Where, yes, I know what I could put into this, where I'm a defined contribution section now. All that money is in a defined contribution, which means that everything, I know what I put in, but I don't know what I may get due to the market fluctuation. And then when I need it, there's all these rules. There's rules. So why should I buy term and invest the difference in vehicles that can't guarantee me a difference? You see, guys, these are things we must know. Because in order for this, listen to me, in order for the buy term invest the difference to work, here's two things you must do. Number one, you must have the discipline and the consistency to invest the difference. If not, you may end up buying term but spending the difference. And when uncertainty about the economy and ever-changing job market and consistency can be a challenge. Number two, you must know how to invest the difference. Other investments may be able to give better rates of return, but they may also sink your nest egg. So in either case, guys, you just got to know that if the investment haven't performed well at the end of the term, then the cost of insurance will go up substantially high. And then what? What happened then when you can't afford it? You have no insurance and no investment. How's that for buy term, invest the difference? But what about things like universal life? Is universal life any better? Well, you be the guest of this. Now, universal life, it works like this, guys. There's a big difference between universal life and whole life, right? Big difference. And the difference is that it's very flexible, right? That's what the modern day people need, flexibility. We as middle class and lower class need something with flexibility. Flexibility. We don't want to feel like we're tied into something locked and sealed. No, we need some flexibility. So you could change your premium with a universal life. You can pay more one month or less the next. Sometimes when you face money problems, you can even skip a few months' payments as long as you have enough money to pay for the cost of insurance. Did you know that? Did you know that you can even adjust the death benefit, right, with ever life-changing conditions, right? You could do all these different changes. Something that a whole life won't allow you to do, nor a term insurance would allow you to do. Term and whole life are very fixed product. If you don't pay the insurance, it will lapse. There's no cash value in term insurance. There's no cash value in term insurance. Anybody tell you that there's cash value in term insurance, slap them. Because they just lied to your face and took you for a fool. I know someone that happened to. Literally. They're on our team. Someone from that particular company tell this person that they will have cash value after their 30-year term is up. So now they're lying to the public. This is crazy. But what is an index universal life? Now, when I say, maybe it's favoritism. I love index universal life because I understand how to design them. I understand how to put them together. Most people don't. And that's why they're confused about the whole aspect of an index universal life. They don't get it. But if you know how to design an index universal life for a client or a family, you can give them one of the most amazing things out there. Let me tell you why an index universal life is powerful. Listen to this, guys. It's just like a universal life. It has all the flexible features, but you got to pay attention to one word that changes it, and it's the I in front of IUL. Index. Did you know that Warren Buffett, one of the richest men in the world, made a bet with everybody? And win this bet every year, or every time that he made the bet, he won it, that his index will outperform any hedge fund. His index accounts will always outperform any hedge fund that was out there. Look it up, Warren Buffett $1 million bet. It's a crazy thing. Now, here's the thing. Here's how the index works. This is the key part of the index universal life, right? The key part of the product is that the cash value is based on a certain index, such as like an S&P 500, the NASDAQ, the Dow Jones, the Euro stocks, all these things, right? So here's the thing. Did you know, as far as your money go, your money is not directly in the index. Instead, the cash value inside the policy is credited with a return based on the performance of the index. Did you know that you have a growth? You can earn growth based on the index, but up to a ceiling maximum, which they call the cap. So you could earn an interest on your money up to a certain cap. The cap means that you could go up to, let's say, 13% as a cap. So if the market does 5%, you will get 5%. If the market does 10%, you make 10%. If the market does 20%, you can only make 13 out of that 20%. But then it also comes with a floor. It comes with a floor, guys, which means that if the market goes down -1, you could get 0%, which means you don't lose what you already made. If the market is -20, you still get 0%, which means you never lose what you already gained. You can't lose. You can't lose money inside of your index universal life. So why we never learned about these things? Right? Why we don't learn? Why haven't we gotten a chance to learn about these things? It's because nobody sat down with you, and most of these companies don't even have access to an index universal life. Like I've told you guys the history. Index universal life was created by a company called Western Reserve, which is our company. This was brought to our country by our company. Then you had other companies like Nationwide. You had other companies like Pacific Life. And, different companies started jumping on the bandwagon and started doing IULs too. But did you know our company is one of the only companies that actually offer you 3 different indexes? Where you have access to like a Hang Seng, a Euro stocks, S&P 500. Imagine that. Imagine that. Why most of you guys never knew this? It's because they didn't want you to know. So what is an accidental? What's an accidental death insurance? It's very simple. If you get in an accident, they pay out. But they don't just pay out if you just get in an accident. It's how you die in that accident, because you got to die in that accident. Then they pay out. Right? It's not the aftermath of an accident that make them pay out. You got to die due to the accident. So you got to die in the accident. That's what's called accidental death insurance. How about joint life? Joint life, most married people use this. And it's when they join life, right? So some of them even call it first to die or a second to die insurance, where, for example, if 2 married couple are together and they have a first to die, right, policy, it's the first person died that they pay out, but the person that the second person that survived don't have any coverage anymore. They already pay out. But then they have a second to die, meaning that if the second person passed away, right, then it will pay out. Not when the first person passed away, the second person, right? Sometimes it even call it that survivor's insurance, right? So guys, it's better to get your individual. That's why I recommend spouses that live together to get a separate account, because sometimes it's even cheaper, right? Sometimes it could be even cheaper that way and less headache. How about key person insurance? Now, key person insurance, a lot of business owners use this. A lot of business owners use this because if you are the key person of your insurance of your business, then you want to have coverage. You want to make sure that you have coverage on yourself as the key person. And plus, if you set it up properly, you can even get and talk to your CPA about this or an accountant. They could show you ways how, if you set it up properly, you can even get a tax credit, right? Because as an expense to your company, if you are the CEO of your company. You also have executive bonus life insurance, which is really, really awesome too. It's a very great way where corporations offer this as an incentive, as a way to really keep their executives, give them something like an extra bonus. Executive bonus is pretty simple. See, this life insurance policy pretty much offer an executive in the company, and the company pay the premium and can deduct the tax exempt distribution, and pretty much the executive receive the benefit of it. And with an executive bonus policy that have cash value, pretty much the executive can take out a loan against a policy. However, if he or she must claim that premium payment as a regular income, and in the event of the executive pass away, the family will receive the benefit as well. So it's a really cool product if they understand it and pretty much learn it some more. But then you also have final expense insurance, guys. Final expense insurance. What is final expense? Well, it's also referred to as a funeral expense insurance, and this insurance is used to pay for funeral costs, and this give a peace of mind to those in their last final days without creating additional financial burdens to their loved ones. All right. So final expense insurance, it doesn't require medical in most cases. And some of them is just asking a few questions and they'll give you coverage. This type of money will be able to pay out to your loved ones within 48 hours of you passing. A lot of them come with concierge services too. And it's an easy underwriting. Like I said, it could be a phone call where they do a phone interview or they do a paperwork and they get it done. You can even know if you get approved right on the spot. And I always tell you, you need life insurance and final expense insurance, guys. So what are some of the living benefits of life insurance? Some of the living benefits of life insurance is things like accelerated death benefit, right? And it's a feature where the insurance company pay an advanced portion of the policy, and the death benefit insured will be paid, to take care of the treatments. And if the insured dies, then the balance of the death benefit will go to pay the beneficiary. So in case of serious illnesses like heart disease or stroke or cancer or paralysis or terminal illness with diagnosis of less than 12 months to live, then the accelerated payment will be able and it'd be very helpful for the insurer's family. So life insurance is not just about when you die, guys. It's not about when you die. Life insurance is about living, because it can take care of a lot of living issues when you're alive. So what are some of the tax advantages of life insurance? I'm just going to run through them real quick. But I want you guys to know this. This is not me speaking now. This is me giving you information. You ready? Did you know under the Internal Revenue Service, which is the IRS guidelines, did you know that insurance policies receive favorable tax advantages? And some of the tax advantages that we're talking about is tax-free death benefit. Say that with me one more time. Tax-free death benefit. And the tax-free death benefit means that should the insured die, the entire death benefit, including the cash value, is income tax-free to the beneficiary. You also get tax deferred earnings, which means that you do not pay taxes on the gains in the policy, right? The tax is deferred until you decide to surrender the policy and the policy has lapsed or when a certain distribution occur. Did you know you get tax-free withdrawals and you also get tax-free loans? You see, guys, as long as you stay within the IRS guidelines, the insurance, listen to me, the withdrawals and the loans can be taken out without federal income tax liabilities. Did you know that? That's why it's important for you to learn more about tax, right? I told you, if you understand taxes, you know where to put your own money. If you understand taxes, you know where to put your own money. So I hope you guys learned a lot today. I hope you guys took down some amazing notes. But at this moment, I would love to open up the call. So anybody have any questions, right? Hit the yes button. If you have any comments, questions, anything you'd like to ask, you're more than happy to do so. I'm going to open up the call for anybody. Just press that yes button. Go into your participants section right now. Hit that yes button, and I will call on you for your question or your comment. All right. Anything, Ben?
Yeah. Yeah, I was just gonna say that this is some good information. Definitely a lot of vocab, which is a reminder from recently taking the life exam to become licensed. Definitely a lot of like the terms that we learned in that pre-licensing course that are, you know, once you understand the terminology, then you understand, you know, really what you're looking at. Because I know that before taking that class, I had some of these terms kind of just floating around in my head, didn't really understand what they meant. And before being introduced to WSB, I had no idea about anything about an index universal life. And so I definitely think that, you know, learning the terms, reading about them, understanding them, and as you said, once you understand it, then you can make a very informed decision that's going to be best for you and your family. And you know, I also, if you haven't like taken that course, or if some of these terms are new to you, just remember that everything that we're covering is in the Saving Your Future book. So, you know, you can always reference this information as well if you missed something in the Saving Your Future book, and, you know, read over it. So just a lot of good information here. So I appreciate it.
Anytime. Anybody else? All right, we have Mr. Ricky. Good morning, sir.
Morning, good morning, good morning. Just like to
Morning.
say, you know, you did a really good job, very informative. You know, I recall a lot of times through secondhand information, I used to watch movies and or read books, and you hear about people like talk about, they didn't really say tax advantages or insurances, but they talk about stuff like hedging their bets, protection. And all of that is actually just forms of insurance. And so just to have you break it down so we can see the different types of insurance products and the different way that we could actually hedge our bets. It's very informative, and thank you very much.
You're very welcome, Mr. Ricky. Anybody that's like to share, please hit that yes button so we can call on you next. All right, good morning, Miss Sheila. You're live.
Hey everyone, good morning. Good morning. Another great money talks. I love the way you break down and make it plain for insurance, because there was something in it that I learned that helped me out a little bit more this morning when I'm trying to explain term and the return of premium. I didn't know that, you know, that you would have to pay taxes on that money when you got it back. So that was another thing, you know, that I learned on this morning to add to my knowledge of when I am speaking to people. I am just so excited on this morning to, you know, to be on another Money Talks, and just to hear, you know, all of this wonderful knowledge that is being given, and it's all being done for free. So thank you for your time. Thank you for your commitment to the Money Talks, and just continue to, you know, educate us and give us more information so that we can just help not only ourselves, but to continue to help our friends and families as well.
Absolutely, anytime. More than welcome. More than welcome. I'm excited to be able to keep doing that for anybody and everybody. That's what Money Talk is all about. It's about empowerment. You know, we're just gonna keep empowering ourselves so we can empower others. Anybody else before we close out? I'll take one more real quick. All right. So we're good. So all right, thank you guys for definitely tuning in today. It's definitely an amazing talk. Tomorrow is Wednesday. So tomorrow you guys will have the pleasure of me breaking down if I remember correctly, I think it's annuities. Yep, it's annuities. And this Thursday, I'll be breaking down different retirement plans. So, you know, tomorrow I'm going to break down annuities to you guys. You will learn about different kind of annuities. You learn about a variable annuities. You learn about a fixed index annuity. You learn about a fixed annuity. You learn about all kind of annuities tomorrow. So you don't want to miss it tomorrow. It's going to be a life-changing, conversation tomorrow. You're going to learn about some amazing things. And then Thursday, just to give you a heads up about Thursday. Now, Thursday, I'm going to break down retirement plans. So you're going to learn about not only your 401ks, your pensions, your 403bs and stuff like that. You don't want to miss that. If you've never been a part of that series before, don't miss it. I'm telling you right now, you want to know what I'm going to talk about this Thursday as well. So definitely it's going to be an informative week. I hope you guys are getting good information, great understanding. And once again, remember that every Mondays and Wednesdays and Fridays and Sundays at 10 a.m., 12 p.m., and 6 p.m., we are educating families about 4 ways to financial freedom and breaking down financial concepts. So don't miss it. You can invite your friends. You'll get to hear from the best of the best educators. You get to learn from them. You get to understand the basic concepts of how to build wealth in America. All right. So you don't want to miss that, guys. Make sure you invite your friends and relatives till Monday, Wednesday, Friday, and Sundays at 10 a.m. or 12 p.m. or 6 p.m. Eastern time. These are all Eastern times. All right. So if you're anywhere else, I just look up your time and we'll have those information out for you guys. All right. So thank you guys for always tuning in. I hope you, like I said, I hope you learned a lot. And with that said, guys, until next time, let's, on the count of 3, let's all wish out. 1, 2, 3. Let's whoosh, guys. Whoosh. World team, one
team,
one system, one
One
cause.
system.
Woo! Have a good day, everybody. God bless.
Nice.
God bless you.